Hi everyone, this is Ken Shreve with Investors Business Daily. Welcome to the Level 2 Home Study Program. In this DVD set, you'll learn advanced market tracking techniques that will help you spot market tops and bottoms. You'll see in detail the specific fundamental analysis and chart reading methods used to find stocks with the greatest potential. And you'll also discover the steps to take to protect your gains by identifying warning signs early on. Let's start with the market timing section because the easiest time to make money is when the market's in an uptrend. Decades of IBD research has repeatedly shown that market bottoms look a lot alike. New market rallies have always been confirmed by a follow-through day, so let's take a look and see what one looks like. Once you learn how to recognize a follow-through day, you'll be able to maximize your returns by being in the right stocks at the right time. Let's start by taking a look at the anatomy of a follow-through day. Here's a look at the S&P 500 back in October 1998. Remember that a follow-through day is confirmation of a new market uptrend. No bull market has ever started without a follow-through day, so it's important to recognize when one occurs. That being said, not all follow-through days are going to work, but you always want to be aware when one occurs because, again, no bull market has ever started without a follow-through day. Again, the S&P 500 back in October 1998, the S&P 500 was on a sharp downtrend. The market was in correction mode. When you're looking for a follow-through day, you want to see day one of a rally attempt, and that's what you saw right here. The percentage gain doesn't matter on day one of a rally attempt, nor does the volume. You're just looking for any up day in the market. Look at what happened the very next day, though. The S&P 500 closed lower, and its intraday low undercut the prior low of day one of the rally attempt. So that automatically kills the rally attempt, and it's time to start looking for day one of a new rally attempt. The S&P 500 closed lower for 3 days in a row. Here was day one of a rally attempt right here. After you see day one of a rally attempt, then you want to start counting because follow-through days are going to occur on day 4 or later of the rally attempt. You really don't want to pay attention to day 2 or day 3 of a rally attempt because sometimes there can just be short covering going on, and that can give investors a false sense of security that the market is acting healthy, but it really isn't. So don't pay attention to what happens on day 2 or day 3. Look for a follow-through day on day 4 or later. And that's what happened. You had day 2 of the rally attempt, day 3. Day 4 is when you start looking for that follow-through day, and then day 5 right here is when the S&P 500 showed that sign of strength that you want to see at a market bottom. It made a big percentage gain in higher volume. That's another critical element of a follow-through day. You want to see volume pick up from the prior day's level. So big percentage gain. Typically a follow-through day, you want to see a percentage gain of 2% or more. Follow-through day should really give the feeling of unequivocal strength, not something that's on the fence with a 1.5 or 1.6% gain. You want to see a good strong percentage gain and higher volume. And remember, this rally here would have been declared dead at some point if this low had been taken out, but it never was. You had the follow-through day right here, and it spawned a nice little rally. Remember one important tenet of follow-through days. Every bull market in Wall Street history started with a follow-through day, but not every follow-through day launches a new bull market. Follow-through days have a pretty good success rate, but the other key ingredient you need for a successful rally is plenty of stocks breaking out of bases, asserting leadership. Without that, a rally could take a while to develop. Now let's take a look at the Nasdaq's follow-through day in March 2003, which launched a new bull market. In March 2003, there was a powerful follow-through day on the Nasdaq. I wanted to take a look at the Nasdaq's action a little bit before then in October 2002 because you did have a follow-through day here. Here was day 1 of a rally attempt, and on day 4 of the rally attempt, you had a big percentage gain. This was on October 15th, 2002, that marked a nice little rally for the Nasdaq. Little 19% gain. This was an example of how a follow-through day can launch a tradable rally, not necessarily a new bull market, but this was a time where there was good money to be made in the market. Even though it was a fairly short rally, the Nasdaq did rally 19% to its high of 1521. Then look at what happened. The Nasdaq went into what we call 3 legs down, and the concept behind 3 legs down is when sellers are getting flushed out of the market. So the NASDAQ went back into correction mode here, more than likely killing the rally attempt. But you can see the low of 1327 was undercut over here. It hit a low of 1261. The fact that this low was taken out means that sellers were getting shaken out of the market. And then the NASDAQ put in a low here that just barely undercut the low of 1261. This type of action, 3 waves down, again, serves to shake out sellers in the market. Then it's time to start looking for day 1 of a rally attempt and see if you can get a follow-through day on day 4 or later. So this ended up being day 1 of a rally attempt. Here was day 2, day 3, and then day 4. You had a powerful move in the NASDAQ on day 4 of the rally attempt. This occurred specifically on March 17th, 2003. It jumped 3.9% in higher volume. So that was the follow-through day. Again, if this low right here had been taken out, the rally would have been declared dead. But big percentage gain in higher volume here. And you can see it took a little while for the market really to get going, but this was the sign to get back into the market and start looking for leading stocks to buy. You can see it launched a nice, powerful rally in March 2003. NASDAQ was up 55% in 45 weeks from the follow-through day. Market bottoms, 1998 NASDAQ bottom. We started off this market timing section by looking at the S&P 500's follow-through day in October 1998. Well, the NASDAQ was also acting strong at the time. Here, the market was clearly in trouble here. You can see it was in the throes of a correction. You actually did have a follow-through day right in this area here, a little bit before the October follow-through day. The follow-through day occurred on day 6. Again, here was day 1 of a rally attempt, day 2, 3, 4, 5, 6. Here was your big percentage gain in higher volume, and that did indeed launch a nice tradable rally. But NASDAQ goes into correction mode, a lot of professional selling in the market. Still time to look for day 1 of a rally attempt, so let's see how that played out. Here's day 1 of the rally attempt for the NASDAQ in 1998, day 2, day 3. Remember, this low has not been taken out, so the rally attempt is still intact. Day 4, and then day 5. Big percentage gain in higher volume here. Notice that volume picks up from the prior session. And in this case, the NASDAQ closed lower the very next day, but that's not going to kill the rally attempt. You got your sign of strength right here, a 5th day follow-through day. So the fact that the NASDAQ declined wasn't such a big deal. You can see volume was lower than the prior session. But then you get a distribution day. A distribution day is a heavier volume decline, and it is a sign of institutional selling. General rule that IBD follows is that when you get a follow-through day and you see a distribution day or heavier volume decline within a 3-day window after the initial follow-through day, our research shows that the rally is going to fail half the time. Okay, so the fact that the NASDAQ marked a distribution day 2 days after the follow-through day, that was a yellow flag that this rally may have some trouble. Okay, then what happened is that the NASDAQ did manage to rally a little bit higher, but then you had another distribution day right in this area here, a heavier volume decline, another decline in the NASDAQ and lower volume, and then a big percentage decline right here. So you've had 3 distribution days since the follow-through day in a fairly short amount of time. This rally is showing signs of weakness. A little rally attempt for the NASDAQ right here. And then finally, the NASDAQ ultimately takes out the low of day 1 of the rally attempt, so that kills the rally attempt. Again, follow-through days have flagged many market bottoms in the past, okay, but they, of course, don't have a 100% accuracy rate. Nothing does in the stock market. So the fact that this low was taken out officially killed the rally attempt. Start counting again, day 1 of the new rally attempt, day 2, day 3, day 4. You have a 4th day follow-through day in higher volume. Remember, here was day 1 of the rally attempt. So you saw a follow-through day on day 4. If this low here was taken out at any point during the rally attempt, the rally would be declared dead. So you're not looking at the low of day 1 of the rally attempt. You're just looking at the prior low here, right here. So you had a fourth day follow-through day, and then look what happened. You had another sign of strength the very next day. So you had two follow-through days in a row, two big percentage gains in higher volume. This was a sign that the market could be ready to start a nice uptrend, and you can see what followed soon after. So two follow-through days in a row were a good sign of strength by the NASDAQ. Now remember, when you see a follow-through day, that's your clue to start looking for high-quality stocks to buy. There are some instances where you're going to get a follow-through day and leadership is not clearly defined yet. So you don't want to force the issue when you see a follow-through day and jump back into the market with reckless abandon and just buy any old stock. You want to make sure that there are plenty of stocks out there, fundamentally and technically healthy stocks that are poised to lead. When the NASDAQ and the S&P 500 followed through in October 1998, you can see all of these stocks at the time that were breaking out of bases to new high ground that ultimately turned into be big market leaders. Charles Schwab was one of the first stocks out of the gate when the NASDAQ followed through in October 98. See a lot of other tech stocks here: Sun Microsystems, AOL, eBay, PMC Sierra, Broadcom, Applied Micro Circuits. So there were plenty of stocks flexing their muscle at the time, and these are the types of stocks to target at the beginning of a new rally that's marked by a follow-through day. Fundamentally and technically healthy stocks, not stocks near lows, but stocks that are near new highs with top fundamentals that are breaking out of sound bases. And the next section of this home study, we're going to teach you how to recognize what a sound base looks like. So lots of leaders breaking out when the NASDAQ followed through in 98. That was a sign that the rally was going to have some steam. You see what the NASDAQ did, up 233% from the follow-through day over 73 weeks' time. So this was an opportunity to make quite a bit of money. NASDAQ ultimately topped right in this area here. 1974. Again, the purpose of showing you past follow-through days, some of you might say, well, why is looking at a market bottom in 1974, how is that going to help you? This is all about market precedent. Market bottoms actually do look a lot alike, whether it was in 1998, 1974, or any period of market history. Market bottoms have always been put in with a follow-through day. Now, here stocks topped back in late 1972 here and went into a lengthy correction. You can see the S&P 500 in 1974 down 50% in 21 months. Now let's take a look. During this decline, right in this area here, again, a lot of professional selling, a lot of uncertainty in the market, and there were plenty of times where the market did notch a follow-through day, but it just didn't have any staying power because of all the uncertainty and the fact that institutions were basically net sellers of stock. So you had a little follow-through day right in this area here on day 4 of the rally attempt. You can see it just didn't have any staying power. So that's why you want to pay attention when you start nibbling at stocks in the early stages of a follow-through day. You have to keep in mind that it possibly might not work. So again, you don't want to just